Welcome back to Block TV. I'm Ron Friedman. In a few moments from now, the Senate Banking, Housing, and Urban Affairs Committee is set to begin a hearing dedicated to cryptocurrency regulation. Today's hearing comes exactly 2 weeks after the committee convened for a public hearing on Facebook's soon-to-be-launched digital asset, Libra. In that hearing, senators spent hours grilling Libra chief David Marcus on the ins and outs of the project, placing special emphasis on Facebook's involvement and steps it was taking to ensure compliance with U.S. policy. I'd like to take a moment just to a reminder for our viewers how that all played out. Let's take a look at that clip and carry on.
Look at Facebook's record. We'd be crazy to give them a chance to experiment with people's bank accounts, to use powerful tools they don't understand.
We will take the time to get this right. If our country fails to act, we could soon see a digital currency controlled by others whose values are dramatically different from ours.
Do you trust your currency so much that you and your team are willing to see 100% of your compensation be paid to you in that currency? Which it could be if you decided it could.
Senator, if your question is whether I would trust all of my assets in Libra, the answer is yes, I would, because it is backed.
My question was,
and my pay.
Do you trust this enough to make your compensation paid fully in your currency?
Senator, I would, because it is backed one for one with a reserve.
You could have said yes at the beginning of the question then. Okay.
Will you at least clarify your answer to Chairman Crapo's question and say Facebook will make sure that WhatsApp and Messenger will support third-party wallets?
Senator,
yes or no?
Senator, I want to clarify because there's a nuance.
Not clarification. This is fair. You didn't answer Chairman Crapo. Please answer my question.
When it comes to cash and carrying around a briefcase full of cash, transnational criminals and terrorist activities don't do that anymore. And what you are creating right now is an opportunity for them to engage in continuing money laundering and criminal activity. So know that.
Now, today's hearing is going to be a bit different, I'm sure. To tell us what's in store, I'm joined in studio by Block TV editor Alon Sinai. Hey, Alon.
Hey, Ron.
Another day, another hearing on Capitol Hill, but a bit of a different scope, a different focus from what we had 2 weeks ago, right?
Yeah, well, obviously, 2 weeks ago, it was completely focused on Libra. Today, even we can see in the title of the hearing, it's we're examining crypto and blockchain regulation framework. So this is a far wider discussion, and we're also seeing the witnesses appearing in front of Congress. Right. They're different people. We have a Circle CEO, Jeremy Allaire, who's representing basically the Blockchain Association in a way, the entire crypto community.
Right, he's our ambassador in Washington today, Mr. Allaire there.
Yeah, so lots of hopes from him. We'll touch later on what he has to say. We have Rebecca Nelson, who's a member of the Congressional Research Service. She specializes in international trade. So she's, I guess, in a way, an in-house expert from the Congress, and she's going to touch on what she sees in crypto. I think she's really going to give, we've seen her testimony, she's going to give a bit more of a background where crypto came from, where it is going. And finally, we have Mahersa Baradaran. She's a law professor at the University of California, Irvine School of Law, and she's going to give she's an expert witness, again, to talk about wide-ranging aspects and, I guess, implications of this.
So before we kind of drill down into them and their agenda, generally speaking, it's going to have, we're guessing it's going to have a bit of a different feel. I mean, last time it was one central focus. It was Libra, their product. Can we guess that maybe it's going to be a bit less confrontational this time?
I think so, yes. I mean, anything compared to Congress towards Facebook is going to be less confrontational. But it'll be interesting to see how they approach Allaire, actually, because just last week, Circle announced they're moving part of their business to Bermuda.
Absolutely, and I think that's maybe one of the impetus, not necessarily Circle's move, but the fear by U.S. Lawmakers that lack of regulation or the wrong type of regulation might actually drive businesses away from the United States, which is not an irrational fear.
Yeah, I guess on the one hand, he's going to be saying, look, I had to do it. On the other hand, he may be attacked by these Senate members. They're going to be saying, look, what example are you setting here? You could have waited a little longer. Maybe it wasn't something you had to do. So it'll be interesting to see how they approach that.
So like you said before, we have some of what he plans to say. Let's
take a look at part of his testimony. We have it here. So basically, Jeremy's saying towards the end, what he's going to say. As the largest economy in the world and the home of the largest financial markets infrastructure, the United States has built robust regulatory and supervisory frameworks for financial institutions that have served as a model for other countries. He goes on to say that this is a huge asset for the US and the global economy, and the legal frameworks that have been adopted and amended over the past 80 years and are without a doubt foundational to market stability and risk management. So some interesting stuff there.
Right, so he's paying his respects, saying, this is, our natural inclination would be to remain here, but that's a bit but.
We need you to move faster. We need more regulatory clarity, and we need it to happen very soon.
Right, Alon, hold on a second. We're seeing first images here from the live broadcast at the Senate Banking, Housing, and Urban Affairs Committee. As we can see, the senators have already streamed in, and everybody's taking their seats. Just first impression. A much smaller venue.
Yeah, absolutely. You can see it's obviously not full yet, but see the senators already underway there, and let's see where we're going.
All right, let's pick up the sound from there. See if they're already starting opening statements.
Wallet service, Calibra. Facebook's Libra project has generated renewed interest in digital currencies and blockchain generally, including how they interact with U.S. and international regulatory frameworks, the potential benefits and challenges they pose, and concerns around issues like anti-money laundering and counterterrorism efforts, including data privacy, consumer protections, commerce, and monetary policy.
I'll give you 5 more minutes.
A few weeks ago, the head of Calibra, David Marcus, joined the committee to provide an update on Facebook's proposed digital currency. During that hearing, Mr. Marcus emphasized some important points and commitments, including that there are a number of regulators globally that are currently engaged on the Facebook project, including the Federal Reserve, FSOC, FinCEN, Financial Conduct Authority, and the G7, and more. Calibra and the Libra Association will have the highest standards when it comes to data privacy, and no financial data or account data that is actually collected in Calibra will be shared with Facebook. And that the Libra Association will be headquartered in Geneva, Switzerland, but will still register with FinCEN and have oversight from U.S. regulators. Though while Libra may have begun this conversation, the blockchain and cryptocurrency system is diverse. It seems to me that these technologies and other digital innovations are inevitable. They could be beneficial, and I believe the U.S. should lead in their development. That can't happen without clear rules of the road. As the U.S. develops a more comprehensive regulatory approach, care must be taken in determining what gaps may be present in the existing framework. In mid-July, Treasury Secretary Mnuchin said, "To be clear, the U.S. welcomes responsible innovation, including new technologies that may improve the efficiency of the financial system and expand access to financial services. That being said, with respect to Facebook's Libra and other developments in cryptocurrencies, our overriding goal is to maintain the integrity of our financial system and protect it from abuse." He also noted that Treasury has serious concerns regarding the growing misuse of digital currencies by money launderers, terrorist financiers, and other bad players. As digital currency efforts move forward, I'm particularly interested in better understanding how these technologies may impact individuals' ability to exercise control over their data, including the right to receive information about and access their data, correct inaccuracies, and delete their data. During this hearing, I look forward to hearing more about how the market for digital currencies has grown and evolved over the last decade, different types of digital currencies in the marketplace, including their differences with Facebook's proposed digital currency, how other countries are approaching the regulation of digital currencies and blockchain technology, and what we might learn from their successes and failures, potential gaps in existing regulatory frameworks, whether distributive ledger technology can help to facilitate meaningful privacy for individuals' data, and approaches Congress should consider in developing a comprehensive regulatory regime for digital currencies, including ensuring individuals have real control over their data. With the appropriate balance of regulation, Digital currencies and their innovations and their innovative underlying technology could provide meaningful benefits. And I look forward to learning more about the ecosystem during this hearing. Senator Brown.
Thank you, Chairman Crapo, and welcome to our three witnesses. Thank you all for joining us, some of you more than once. Thank you. This committee hearing earlier this month, many of us in both parties, as you could hear from the chair, voiced concerns, serious concerns about Facebook's plan to run its own currency out of a Swiss bank account. By and large, we mostly heard deflections and dodging, exactly what we mean when we say Facebook doesn't understand accountability. Facebook has proven over and over through scandal after scandal that it cannot be trusted. But they just don't care. They move fast, they break things, minor things like our political discourse and journalism and relationships and privacy. Now they want to break our currency and payment systems, hiding behind the phrase innovation. They want to innovate Americans right out of their hard-earned paychecks. Look around at what happens when big corporations say they want to innovate. Before they blew up the economy in 2008, bankers were pitching an innovative new product called subprime mortgages. Just like Facebook, which claims its new currency will help the unbanked and the underbanked, a bit of an afterthought, I think, as they were selling it. These mortgages are supposed to help people who never had access to credit achieve the American dream of home ownership. In reality, these mortgages ripped off millions of families who ended up losing their homes. They wrecked the economy. They made the staggering inequality in this country even worse. The only innovative thing about the financial crisis was how the banks managed to stick everyone else with the bill, not exactly the kind of innovation most of us were hoping for. So I'm all for innovation, especially if that innovation delivers on its promises of improving people's lives. But big tech companies, Wall Street banks, are hiding behind innovation as an excuse to take over important public services we all benefit from and should all have a say in. There are some things, our currency, our payment system, the protection of our savings accounts, that everyone in the country has a stake in. We shouldn't be handing those kinds of public resources over to wealthy special interests so they can squeeze more profits out of ordinary Americans. Think how hard it is to get quality service from Comcast, to know how your privacy was invaded by Facebook, or to know how much of your personal data was leaked by Equifax, and we just learned in the last 24 hours, Capital One, and who's next? We don't know. So we should be a little suspicious when someone tells us that only big corporations can be trusted to provide critical public services. I recently moved into a new office. It was John Glenn's office. When he served obviously served Ohio in the Senate. He and I moved there because he and Annie are longtime friends. We've known each other for 30 years. John Glenn spoke at my Eagle Scout dinner in Mansfield, Ohio 50 years ago. But I moved into that office because primarily he was an innovator. He was the first American to orbit the Earth, as we know, as part of the Mercury project, which would be followed by the Gemini and Apollo missions that would eventually put Americans on the moon. Many of us who are old enough joined in the celebrations of the 50th anniversary, at least some of us on this podium are old enough, joined in the 50th anniversary. We all did that, but remember the day 50 years ago, just this month. None of the astronauts did it alone. It took the hard work of thousands of innovating scientists and engineers, most of them unknown, people like famed mathematician Katherine Johnson or immigrants like engineer Miguel Hernandez. These Americans didn't do it for profit. They did it to serve their country, and their successes were shared by every American who saw USA emblazoned on the side of Apollo 11. It's a reminder that some infrastructure works better as a public good, and we shouldn't let big banks or big tech get their hands on those public goods. The Federal Reserve and other watchdogs need to continue to be leaders in banking innovation. And if we don't move quickly to improve important infrastructure, not just roads and bridges and highways and water sewer systems, but our payment system too, if we don't move quickly to improve it, we'll end up with big corporations that have broken our trust again and again and again, and that doesn't make any sense. I look forward to hearing from our witnesses today about which of these technologies might actually help regular Americans. Thanks.
Thank you, Senator Brown. Today's witnesses are Mr. Jeremy Allaire, co-founder, chairman, and CEO of Circle on behalf of the Blockchain Association. Dr. Rebecca M. Nelson, a specialist in international trade and finance at the Congressional Research Service, and Professor Mirza Baradaran, Professor of Law at the University of California, Irving School of Law. I'd like to assure each of you your written testimony has been entered into the record. We encourage you to try to follow our 5-minute rule by watching that clock in front of you so that we have time to ask you our questions. And with that, let's begin in the order in which I introduced you. Mr. Allaire.
Thank you, Chairman Crapo, Ranking Member Brown, and members of the committee. It is my pleasure to appear before you today to testify about the promise of digital assets and blockchain technology. I've spent the past 25 years building internet technology platforms and companies in the United States, serving millions of businesses and hundreds of millions of consumers. In 2013, I co-founded Circle, a global digital currency company seeking to make it much easier for people and businesses everywhere to create and exchange value with the same ease that we create and share information and content on the internet. I'd like to start by touching on some of the challenges I see in the global financial system today. Billions of people lack basic access to financial services. Those who do have access face a system with exorbitant fees and excessive risk. Our banking system is riddled with money laundering and crime, with annual illicit proceeds laundered through our financial system exceeding $2 trillion, and with 99% of laundering going undetected. Our financial system is also overwhelmed with privacy violations and data breaches. Cyber criminals and hostile nations continue to take aim at our financial infrastructure. The costs of this are spiraling, and the situation seems to be getting worse. Access to capital for small businesses is extremely limited, with capital markets reserved for only the largest companies and those with access to venture capital, and very few people have a chance to even invest in these startup companies. There absolutely can be a better future ahead, one built on digital assets and blockchains. These technologies represent one of the most significant innovations in modern history. I believe that blockchains and digital assets will be viewed as more impactful than the rise of joint stock corporations, double-entry bookkeeping, and modern banking. In the coming decade, we'll see a series of profound changes. Digital currencies will proliferate and become usable by billions of people on mobile devices. Payments will become a commodity-free service on the internet. A new set of internet-based global capital markets built on digital assets will emerge, opening up capital markets for businesses and investors everywhere, scaling from today's thousands of companies to a world where every person and business can directly access global capital markets with the same ease that they access e-commerce marketplaces. Commerce relationships will increasingly be running on blockchains, providing a commerce environment with greater security, efficiency, transparency, and enforceability. And new decentralized forms of digital identity will become available, allowing for much safer use of digital services, and which will radically improve our privacy while more effectively thwarting financial crime. As a new fundamental layer of internet infrastructure, blockchains will transform the global economic system. With respect to the policy and regulatory issues facing the world with the growth in digital assets, there are significant issues at stake. In the United States, regulatory uncertainty and the application of laws that do not contemplate digital assets has led to the loss of significant opportunity. The Securities and Exchange Commission, for example, is forced to apply federal laws written in the 20th century to technologies created in the 21st. This has had a material impact on the competitiveness of U.S. companies, with Asian-based companies beginning to dominate the market and is backward rather than forward-looking. Congress should consider new laws that protect consumers while not causing companies to fixate on nearly century-old definitions. The result of the uncertain and restrictive regulatory environment has led many digital asset projects and companies to domicile outside of the United States and to block U.S. persons and businesses from accessing products and technologies. In Circle's case, we have received a license under Bermuda's Forward-Looking Digital Asset Business Act, which provides a comprehensive regulatory framework for companies in the industry, and we are in the process of moving our international-facing products and services out of the United States. It is vital that we allow innovators room to grow in the United States. Congress should adopt national policies that define and establish digital assets as a new asset class, including appropriate rules and exemptions. Without a national policy framework for digital assets, I'm concerned that the United States will not be the world leader in this critical new technology, that it will continue to fall behind, and that it will not fully reap the benefits of economic transformation that digital assets will bring. Thank you for your increased interest and attention to this significant area of opportunity, and I look forward to hearing your questions and opinions.
Thank you, Mr. Allaire. Dr. Nelson.
Good morning, Chairman Crapo, Ranking Member Brown, and members of the committee. Thank you for inviting the Congressional Research Service to testify on examining regulatory frameworks for digital currencies and blockchain. My testimony focuses on the international landscape of digital currencies. I will summarize my statement with these brief remarks. In 2009, Bitcoin was launched as the first cryptocurrency. Cryptocurrencies are digital representations of value. They are generally administered using distributed ledger technology and have no status as legal tender. Cryptocurrencies strive to make payments cheaper and faster. Today, more than 2,200 cryptocurrencies are in circulation. In terms of market size, however, cryptocurrencies are a small niche market. Some central banks and large multinational corporations are looking to take cryptocurrencies into the mainstream. If these initiatives move forward, there could be numerous policy implications for the United States, including for its financial stability, the role of the U.S. dollar, consumer protections, money laundering, privacy considerations, and sanctions policy. I will make 3 points today. First, the patchwork of cryptocurrency regulations around the world. Second, the growing interest of central banks in cryptocurrencies. And third, Facebook is a potential game changer for the market. So the first point is the patchwork of cryptocurrency regulations emerging around the world. Cryptocurrencies are international in nature, but they are regulated by governments at the national level. There are more than 190 countries in the world, and they are taking different approaches to the regulatory issues presented by cryptocurrencies. For example, cryptocurrency regulations have focused on permitted uses, consumer protections, securities regulations, licensing and reporting requirements, anti-money laundering regulations, and tax treatment. Broadly speaking, government approaches fall across the spectrum. At one end of the spectrum, some countries, such as Malta, Singapore, and Switzerland, are striving to become cryptocurrency hubs. They view cryptocurrencies as a potential source of growth, and they actively attract cryptocurrencies with favorable regulation and tax regimes. At the other end of the spectrum, some countries, including China, India, Egypt, and Taiwan, have banned or strongly restricted cryptocurrencies. Their concerns focus on government control of the financial sector, financial stability, and consumer protections. In the middle of the spectrum, some governments are allowing the development of cryptocurrencies while developing regulations to minimize risks. Most major developed economies, including the United States and the United Kingdom, have adopted this approach. Differences in financial regulations across countries can lead to instability, especially if cryptocurrencies are adopted on a larger scale. The second point is that some central banks are exploring the creation of their own cryptocurrencies. Some countries plan to develop cryptocurrencies as a second legal tender. For example, the Marshall Islands is planning to create a cryptocurrency called the Sovereign to raise government revenue. Venezuela launched the Petro, a cryptocurrency backed by oil, as a way to raise money and evade sanctions. Iran and Russia are also reportedly considering cryptocurrencies, at least in part, to avoid sanctions. Other governments are considering making digital versions of their existing fiat currencies directly available to individuals. For example, Sweden's e-krona project strives to reduce its reliance on private payment processing companies. The policy implications of such initiatives for the United States would largely depend on which countries are involved and how the new currencies are structured. The central banks of most major developed countries are refraining from such initiatives at this time. The third point is that Facebook has the potential to be a game changer for cryptocurrencies. In June, Facebook announced its proposal for a new global cryptocurrency, the Libra, to be used by billions of people. The Libra would be backed by a reserve fund of safe assets denominated in a basket of currencies. The Libra Association, the nonprofit to oversee the currency, is headquartered in Switzerland. Many of the details about how the Libra would operate remain uncertain. The Libra has raised a number of questions due to Facebook's lack of experience in the banking sector, the size of Facebook's network, and concerns about Facebook's handling of user data. There are also questions about who would regulate it and how. Earlier this month, the G7 finance ministers and central bank governors agreed that the Libra raises regulatory and systemic concerns, as well as wider policy issues that will need to be addressed before the project is implemented. Mr. Chairman, this concludes my brief remarks. Thank you again for the opportunity to testify, and I look forward to the committee's questions.
Thank you, Dr. Nelson. Professor Baradaran.
Thank you. Chairman Crapo, Ranking Member Brown, and members of the committee, thank you for the opportunity to testify today. In the aftermath of the 2008 financial crisis, many Americans were frustrated with our banking industry that had engaged in reckless risk-taking and predatory practices that harmed their customers. They were frustrated again by government bailouts that seemed to save just the perpetrators of the crisis. Is it any wonder that as so many people lost trust in the system, that they enthusiastically embraced Bitcoin, a new alternative, non-sovereign currency introduced on the heels of the crisis to respond to the very problems of the financial sector, which, as Mr. Allaire wrote, is rigged against average people. I wholeheartedly agree with these concerns. I have spent my career trying to bring attention to issues of inequality and exclusion in banking. While I'm glad the cryptocurrency industry aspires to help the unbanked, I do not believe that in the United States, this is the best solution to the problem. The blockchain ledger is a big technological leap forward, but problems of exclusion and financial marginalization in our financial system are not a result of faulty technology, but faulty policy. One stated goal of Bitcoin and digital currencies is to establish an efficient and public payment system available to all. In fact, Congress already established a public payment system, the Federal Reserve. The Fed's explicit charter is to serve the public interest and to increase the integrity, efficiency, and equity of U.S. payments. The Federal Reserve can and should seek to open its payment system to all Americans. Currently, the payment system is only open to banks. Even mobile apps and fintech providers have to go through a bank. But for a host of reasons, banks are not serving low-income and low-profit customers and communities. As a result, 25% of Americans are unbanked or underbanked. These low-income families spend billions of dollars and valuable time paying for checks to be cashed, refilling prepaid debit cards, and paying bills in person. Practically speaking, the most direct path to financial inclusion is by opening the doors to our already established payment system. It can and must be updated, but the system is secure, handles millions of transactions a day, is accepted by all merchants, and is widely understood. The alternative path for financial inclusion through cryptocurrency relies on waiting for entirely new currencies to be developed on new and untested technological platforms, waiting for wholesale adoption and use, and then waiting for technological advances to penetrate banking deserts, all while unbanked populations continue to spend hard-earned wages in fees. And even if technological solutions are right around the corner and we decide that this is the answer to financial inclusion, we would be reserving the highly subsidized and public federal banking system for those with enough means to be banked and relegating the unbanked to the private cryptocurrency markets. This is undemocratic and unfair. The Federal Reserve and this Congress are in the best position to make this possible by offering real-time payments and retail point-of-contact operations, such as a post office checking account. As far as regulating these cryptocurrencies, I ask that Congress and regulators approach these financial products with a healthy bit of caution. It's the innovator's job to imagine a bright and better new world of disruption and change that will benefit everyone. It is the regulator's role to imagine what could go wrong to create system-wide crisis that could hurt everyone. When it comes to regulating finance, an ounce of prevention is much better than $1 trillion bailout. As innovators look forward, regulators and Congress must make sure that we've learned the lessons of recent history. Though no one wants to stifle innovation or to see the U.S. lose its competitive edge, we should remember that much of the deregulation that led to the financial crisis was justified on these very same worries. Just two examples. The derivatives market was deregulated because industry experts promised that innovative and complicated new products hedged risks. Investment banks and regulators relied on very sophisticated mathematical risk models for risk management instead of old and outdated rules. Not wanting to stifle innovation, derivatives were deregulated in 2002, which led to a $600 trillion market that no one was watching too closely. As financial regulators discovered in 2008, the complex risk models had not hedged its risk at all, but had merely placed many of them on books of their counterparties. The entire sector was exposed. The innovation, the math, and the technology was not the problem. The problem was the humans. Similar promises and assumptions were made about the new and innovative money markets in the 1980s that were also similarly deregulated. The money markets were pegged to the dollar one-to-one, just as Libra and digital fiat currencies are. They promised to be stable and liquid and not susceptible to runs. And they were fine until they broke the buck and threatened a potentially catastrophic run. The Treasury had to step in to guarantee these markets. Cryptocurrencies create new money-like instruments that are tradable and have inherent value. This is not significantly different from derivatives markets, commercial paper markets, repo markets, even historic markets in private bank notes. These shadow banking markets were unregulated for too long and created big problems. So far, none of the cryptocurrencies have reached the level of scale where they would present a systemic threat, but if their ambitions are believed, they will. And we have regulators for that should look to the safety and soundness of the financial sector. Technology has and will continue to fundamentally transform finance, but there has yet to be an innovative technology that has eliminated the risks and frauds and crimes that financial regulation is meant to combat, despite many promises to the contrary. Cryptocurrencies are either a store of value, tradable currencies, investments, commodities, or payment system, or some have promised they are all of these things. There's nothing about all of these things being put on the blockchain that makes it any less likely that it could lead to systemic risk, fraud, insider trading, criminal activity, panics, bubbles, etc. If our securities or commodities or banking laws have become outdated or unnecessary, or if Congress believes that they are too cumbersome, then they should be repealed or changed for all applicable parties, not just newcomers. Technology and innovation cannot undermine public policy. Thank you.
Thank you, Professor. I'm going to use my first section of time to talk to you, Mr. Allaire. It's been 10 years now since Bitcoin was first issued, and the digital currency marketplace has evolved and grown. I think one of you said 2,200 currencies right now, cryptocurrencies right now. Given this innovation and their complexity, it can be difficult to understand the differences between products and their benefits and the challenges that are raised for regulatory climate. Mr. Allaire, how can the U.S. develop a more comprehensive approach to digital currency and blockchain regulation while still acknowledging the unique aspects of different projects?
Thank you, Senator. I think your comment is very accurate in that we have seen tremendous development over that period of time. As noted in my testimony, there's over 2,300 different digital assets that are available publicly in some form. In my testimony, I do outline in great detail the kind of different categories of digital assets. It's very easy when one hears about Bitcoin or Libra to sort of assume this is all the same stuff. And so I think one of the very first things for regulators and policymakers is to really distinguish between the different types of digital assets that are emerging. We see, obviously, these kind of non-sovereign digital monies like Bitcoin. There are dozens of others like that have a focus on kind of privacy-preserving, transmission of value. They implicitly have a kind of monetary policy associated with them. And these kind of new commodity monies need to be regulated as we've regulated other commodity monies with appropriate types of financial crimes controls, as we've seen put forward in with FinCEN and FATF guidance. But also there's, I think, new things that happen in this space. The firms that store these assets, these are effectively digital bearer instruments. So not unlike diamonds or gold or some other bearer instrument, but they're digital, which makes them very, very attractive to people who might want to steal them. Hence, so much of there's been so much activity around theft on these kinds of cryptographically secured assets. And so regulations around the custody of digital assets is a really critical need, and something that a number of jurisdictions have actually put forward and built very specific rules around how do we custody these types of digital assets. I think, as I've also talked about, some of the most innovative technology in this field are what I call blockchain platforms. And these are really general purpose infrastructures for record keeping, transaction processing, writing code that executes different types of contracts. And this is, I think, one of the most important breakthroughs that we've seen frankly, in the history of modern computing. And ultimately can lead to things like secure voting, new forms of governance mechanisms within firms, as well as innovations in financial assets. These types of assets, I think, have the broadest applicability and should be encouraged in their development. I think in the same way that we encourage the rapid development of technical standards that made the commercial internet flourish.
Let me interrupt and ask a further question. As I understand it, when it's been recently that Poloniex, the subsidiary of Circle, transferred its registration to Bermuda and cited, in that process, it was cited that there was regulatory uncertainty in the United States, which was a primary motivating factor. Could you explain that a little better?
Yes, absolutely. I think the really critical issue is that many of these digital assets do not easily fit classifications that we've had in our financial system. We'd like to say, oh, this is like a currency, or this is like a commodity that you'd use or utilize in some way, or this has some feature that maybe makes it look like an investment contract. Many digital assets have features of all three. It's what makes digital assets, I think, very innovative, is that you can construct an asset that simultaneously incentivizes capital, incentivizes customer behavior, provides value in terms of access to goods or services and payments. And that's a breakthrough in how we can develop corporate forms. It's a breakthrough in how we can incentivize and develop businesses and technologies. Unfortunately, in the United States, the guidance that the SEC has given is extremely, let's just say, narrow in terms of what they would deem to not be a security. The vast majority of digital assets, if they were in fact treated as securities, as the Howey test application and the most recent staff guidance provides, effectively would mean that those are not accessible to U.S. persons because the utility value of the asset would not be possible to function if it's treated as a security. So there's a fundamental mismatch between the regulatory structure and guidance that we have here and the nature of these digital assets. And so markets around the world are adopting these, and not just Bermuda, but Singapore, Switzerland, even jurisdictions like France introducing tailor-purposed definitions of digital assets so that issuers can feel comfortable with their obligations. There's investor protections associated with those and security and the like. But which don't try and jam these into the respective classifications we have today.
So my time's expired, but to be sure I understand your point here, it would be, as a part of our policy approach, you're suggesting we should not regulate this set of innovations as securities.
To the contrary, so I'm sorry, I misunderstood the question. Yes, we should regulate these. I believe we need new definitions of digital assets as a new asset class. And that there are circumstances where there are investor protection considerations, there are trading and market considerations, there are also circumstances that have to do with utility, commodity, and end-user usage, and you have to be able to define these in a way where that can work.
All right, thank you. Senator Brown.
Thank you, Mr. Chairman. Professor Broderick, welcome. Congratulations on your move to Irvine.
Thank you very much.
You seem to, like you might be skeptical of Facebook claims of 2 weeks ago in this committee, like the one that it's barging ahead with an innovation that will serve the unbanked and underbanked. Would you, if you can kind of cite some history when innovators, financial service companies, others said that they wanted to bank the unbanked and the underbanked, and what actually happened with those kind of innovative financial services products?
Yeah, this is not the first time we've heard that the main, and as Colibra says, their fundamental mission is to serve the unbanked and underbanked. And I've heard this a lot from the crypto industry over the past decade. We heard access to credit being offered earlier. And one of the ways that was offered is in the subprime crisis. So the idea was we're going to lower underwriting standards and we're going to do the subprime market, the mortgage-backed securities market, and the CDO market. And one of the main justifications was to provide access to credit, to increase financial inclusion. With the tech companies, some of the fintech companies as well, they usually list that as the prime issue.
Thank you. Mr. Allaire, to address this, I'd like you to. Is there any reason to treat cryptocurrencies and other financial services offered on blockchain to treat them differently than the products that have existed from? I want you to answer, Professor Broderick.
Oh, okay.
He spoke to it a bit, and hear your thoughts on treating them differently from what we've done over the years.
No, I mean, the blockchain is new technology. Absolutely. It's amazing, and maybe we'll all be on it soon. That's all fine, but what we're talking about is the digital assets. I mean, this hearing is about the value created, the assets on the blockchain. And so it's sort of a red herring to just talk about the blockchain technology. We need to be talking about what actually is going on in these markets. And so I don't think there's any reason to put whatever we're going to call it, whether it's an investment, a currency, some product of value. It doesn't matter what technology undergirds it. What matters is the risks presented by this. And there's nothing about the blockchain that diminishes these risks like any of the other sort of models that we had previously. That is not something that fundamentally changes the things that regulations are meant to combat.
Why discuss your skepticism that technology alone, like Facebook, Libra, or cryptocurrencies, can address unequal access?
Yeah, I mean, the problems of the unbanked, like I said, are not technological problems, they're policy problems. We have the technology to provide an ATM and a debit card to people. This is what the most popular product for unbanked communities is a debit card. What they need to do is to take their cash and their paychecks to cash it someplace, right? So they need a safe and secure place to store their money, and usually people want something old and dusty like a bank as opposed to some new startup to invest all their life savings in. Okay, so they need somewhere to save their money. They need a way to engage in digital commerce. So we have all of these banking deserts, especially in rural places, and all we need to do is allow some access for that point of contact cash digital. And none of these cryptocurrencies can do that until there is wide scale adoption, and this currency would be acceptable by every single point node that these people are using these payments. And that's just, it may happen, but there's many easier ways to do it.